Assalamualaikum and hello everyone. My name is Ahmad Aiman bin Azri. So today we will present you the question, analyze at least four motives for creative accounting and supporting our analysis with relevant theories. So before we talk about the motives of creative accounting, we're going to explain to you what is creative accounting in the first place. So, creative accounting refers to the practice of manipulation of financial information in financial statements to present a more favorable picture of a company's financial performance or financial position. It involves in the use of accounting techniques that may not be necessarily illegal, but stretch or bend the accounting rules and principles to their limits. So, this will result in financial statements that do not accurately reflect the underlying financial reality of the company. So examples of creative accounting practice include using aggressive revenue recognition methods under or overvaluing assets, manipulating expense accounts, and exploiting loopholes in accounting standards to hide losses and liabilities. So creative accounting practice can be misleading for investors, lenders, and also other stakeholders, and result in very serious consequences for a company, including legal and reputational risk. So now we're going to talk about creative accounting techniques. So number one is expense capitalization. So this involves capitalizing expense as assets, thereby spreading their cost over multiple accounting periods and leading to a higher profit in the current period. So number two is revenue recognition manipulation. So this involves in recognizing revenue earlier than usual or delaying recognition of revenue to a later period to boost financial results. So, and number three is off balance sheet financing. So this involves in moving debt or assets off the balance sheet to make the financial position appear stronger or conceal liabilities. And number four is asset revaluation. So this involves in overvaluing assets such as property or inventory to inflate the company's financial results. So now, finally, we're going to talk about the motives of creative accounting. So number one is meeting financial targets. So usually managers may feel the pressure to meet or exceed financial targets set by the stakeholders such as shareholders, creditors, or analysts. And the motivation behind this could be due to the incentive that is provided to the management based on the achievement of the targets, if they achieve the targets. So, for example, the managers may manipulate financial statements to show a higher revenue or profit to meet these targets. So, this could be explained by the agency theory, which states that the manager is acting on their own self-interest and not in the best interest of the company's stakeholders. So, to understand more about point number one, we need to understand more about agency theory. So, what is agency theory? By definition, agency theory is an economic or organizational theory that explains the relationship between principals and agent. What is the principal agent relationship? In our context right now of corporations, the principal refers to the owners or shareholders who delegate the decision making authority to agents, such as managers, to act on their behalf. But then comes the principal agent problem. The principal agent problem arises when the agent prioritizes their own self interest over the interests of their principals. The agency theory assumes that the agents are self interested and may prioritize their own self interest over the interests of the principals. One approach of mitigating this principal agent problem is through the use of incentives, such as performance based compensation or stock options. Another approach is to monitor or supervise agents to ensure that they act in the best interest of their principals. However, the agency theory has some limitations, such as assuming that the agents are purely self interested and may not consider other factors, such as reputational or social responsibilities.
So hi, assalamualaikum. My name is Muhammad Is. So let's first look into the motive of using creative accounting. The first one, managers initiative and desire. Top management is usually the one that is the most interested in making the company's performance look better than it actually is. So, if the accounting information about the company's performance is injected into the market will react to the news, provided that the market is essential market. This will make the reaction to the players in the market wanted to buy the shares of the company. What will happen is increasing in the demand to buy the shares of the company. Will the supply of the shares unlimited will result in the increase of the share price. So the manager have interest. Let's say if the manager that have the interest of selling the shares will utilize creative accounting to make the share price of the company increase before they set it to attain estimate maximize capital gain. So next we move on to the theory. This motive for creative accounting can be explained by the efficient market hypothesis theory (EMH). By supporting with normative theory stated that the market-based theory which is method of other than historical cost method. Next, assume profit maximization is the primary goal of the management. Furthermore, constructed on the basis of deductive reasoning, regard of the provision of the information for decision making as the main function of financial statement. So we move on to the next motive is to achieve target performance. First, there are few ways the managers can utilize in order to achieve their target performance. One of them is overstating the limit and also delaying expenses. What is the managers will receive in exchange is much easier to get loan. All creditor lend their money to get the principal paid together with the interest of the debt. So before the creditor gives the money to the company, they will make sure that they do a background check of or do some research of the company. One of the most simplest way of research is by checking the financial statement of the company. Managers can leverage this by applying creative accounting to make the performance of the company better to increase the chances of getting the loan to finance their project. So the creditors are most likely to give the loan to the company that seems to be more unstable than others because they want to reduce the chances of not getting their return in the case of the company goes fine up. So unstable company may receive the loan, but with a tighter obligation imposed on them, such as a debt covenant. For example, the company needs to operate with a certain debt to asset ratio. Uh, Increasing the debt further will make the company suffer the consequences imposed by the creditor, such as the need to pay back the loan on the spot or legal action taken against them. This will ultimately make the company harder to operate or might even have to let go some of the project that is potentially a benefit to the company in the long run.
So, for the fourth point, which is boosting executive compensation. So, manager may manipulate financial statement to increase their compensation. For example, if they might use aggressive revenue recognition methods, or they might inflate earnings to show higher performance and trigger bonus payment or stock option so they can be well compensated, be well beyond their actual performance. Now, the reason why managers did this might be because of the positive accounting theory, which is that positive accounting theory states that all individual action is driven by a self-interest and individual act in an opportunistic manner to the extent that the action will increase their wealth. So, for example, what I've said earlier might apply to this theory.
Next is the advantages of creative accounting. On the positive side, creative accounting help large corporation to move up their income pattern in order to avoid attention from authorities and lobby group with political agendas. Companies dealing with volatile markets such as oil companies may use credit accounting to smooth out erratic results in order to avoid alarming their investors. Plus, the company that requires financial assistance may use accounting policy to achieve low debt ratios and high profit margin. The company growth graph can be smoothened and steady to attract investors. Management use this technique to demonstrate consistent profit and high revenue. Investor can be encouraged by seeing future gain in the company budget account. This is how the company that loses money can benefit from creative accounting. Lastly, by using this method, the company can consume some of the financial risk that they may face. Earning management creative account Earning management creative accounting may be used by managers to communicate inside information to investors. In this case, it can help with the financial report. Next, although creative accounting is an ethical practice, but sometimes it can be treated as illegal when the values of the book of account of the firm are unethically or illegally misrepresented, then it can call for some conflict of action. Creative accounting can mislead investor by untruthfully reporting financial information of the firm in the favorable light. The manipulative practice often called as cooking the book. The company will always be at high risk of losing its investors because all the investors figure out what is going on. It will be a disastrous for the company. The investor interest may be endangered. Next, in the long run, it is revealed that the company engaged in creative accounting. The client expectation of the company will be jeopardized. The company will lose business and its hard-won reputation. The company profession also lost its reputation in the public. Lastly, overnight collapse of the corporation giant like Enron affected the investors' confidence to the capital market. That's all for me. Thank you.
So, there are four methods to prevent creative accounting. So, firstly is to conduct a routine audit to make sure that the financial statement are accurate as well as compliant with the accounting rules and standard. The audit should be carried out by impartial third party, for example, external audit firm. So secondly is to implement internal control to prevent unauthorized transaction and as well to identify errors or irregularities. This is effective internal control and should be put in place. So thirdly is to establish a precise accounting policies. A business should have a set of accounting policies that are clearly defined and that is spelled out the step to be taken for recording as transaction and creating financial statement. And lastly is to encourage moral conduct. It is important for a company to reward and encourage moral conduct and to reprimand staff members who act unethically. So, to conclude, creative accounting is often driven by various motives such as meeting financial target, hiding losses or liabilities, as well as enhancing the company's creditworthiness, and as well as boosting the executive compensation. So, this motive could be explained by theories such as agency theory, prospect theory, signaling theory, and as well as principal agent theory. However, these practices are unethical and can harm stakeholders, leading to legal and reputational risks for companies.